If you own a basic S&P 500 index fund, the kind sitting in a huge share of America's 401ks right now, you already have a concentrated bet on everything you're about to hear in this video. You didn't choose it. It's just what owning the market quietly turned into over the last 3 years. So keep one thing in mind as we go, because I'm going to come back to it at the end. In a real boom, money flows in one direction, out into something genuinely new. Watch, over the next 15 minutes, how many times in this story the money just flows in a circle instead, back to where it started. Because right now, some of the most respected financial institutions on Earth, not YouTube commentators, actual central bankers, are using the word bust about the biggest capital spending spree in human history. Let's actually look at why. There's a mechanism almost nobody outside finance actually understands about how this boom is funded. And once you see it, it's hard to unsee. NVIDIA invested $30 billion into OpenAI. It invested $10 billion into Anthropic. It's backed multiple neo-cloud providers that rent out NVIDIA-powered computing capacity to other companies. And in July 2026, the Wall Street Journal reported NVIDIA was in talks to provide a $250 billion backstop to help finance OpenAI's planned data center campus in Ohio, guaranteeing the debt on the buildings, not even the chips going inside them. NVIDIA's stock fell more than 4% within a day of that report leaking. Think about that reaction for a second. This wasn't bad news about demand. This was the market getting nervous about a company backing the debt of the same customer it's already invested billions into. A customer whose primary expense is buying that same company's chips. Defenders call this efficient. Asset manager Janice Henderson has described the whole web of deals as a virtuous circle. Just suppliers, builders, and customers locking in commitments in a market where the most advanced chips are still genuinely hard to get. And there's a real version of that argument. Take Stargate, the joint venture between OpenAI, Oracle, and SoftBank, building a massive data center campus in Abilene, Texas. On paper, it's 3 companies pooling resources to build something genuinely enormous. Bloomberg actually mapped out the full web of these interlocking investments across the industry, and even they described the resulting diagram as almost comical, arrows pointing back at each other in every direction, the same handful of names appearing as investor, customer, and supplier simultaneously on the same chart. Strip away the efficiency argument, though, and the plain version looks like this. The same few companies are investing in each other, lending to each other, and buying from each other. And every single deal gets counted as new economic activity. Money that starts at NVIDIA can end up back at NVIDIA. And along the way, it gets to count as revenue, investment, and demand. 3 separate good headlines from one circle of cash. So if all of that money is moving in such a healthy, self-sustaining circle, why is everyone suddenly borrowing so aggressively to keep it spinning? In just the first 5 months of 2026, AI hyperscalers, Amazon, Alphabet, Meta, Microsoft, and Oracle, issued $159 billion in corporate bonds. That's more than those companies borrowed combined over the previous 5 years. Alphabet separately raised $85 billion in equity. NVIDIA issued $25 billion in bonds of its own, its first bond sale since 2021. Amazon alone reportedly moved to raise another $25 billion through a separate debt sale. And, tellingly, people familiar with the deal say Amazon specifically told underwriters it wouldn't seek additional debt financing for the rest of 2026. Read between the lines on that one. That's not a company casually mentioning its plans. That's a company trying to get ahead of investors who were already starting to ask, out loud, how much more of this borrowing they were comfortable with. Nothing reassures a nervous investor quite like volunteering a promise nobody actually asked you to make. That's not what it looks like when a business is drowning in cash from its own success. That's what it looks like when the spending has outrun the cash actually coming in the door, and the gap has to get filled from somewhere. And look, maybe that's fine. Companies borrow to build things all the time. That's not inherently a red flag on its own. But it's worth sitting with the contrast. This is an industry whose entire pitch to investors is, the demand is real and enormous. Borrowing at a pace that suggests its own balance sheets don't quite believe that pitch yet. If you're waiting for the punchline where I tell you exactly why they need the money that badly, hang on, it gets better. Or worse, depending on your portfolio. Because something about this should genuinely confuse you if the demand really is as certain as everyone's spending like it is. According to a JP Morgan analysis from earlier this year, roughly 60% of the data center capacity that companies have promised to deliver by 2027 hasn't even broken ground yet. Another 7% is already delayed. Somewhere out there is a beautifully rendered architectural drawing of a building that, as of this recording, exists exclusively as a beautifully rendered architectural drawing. So hold two facts in your head at once. Hundreds of billions of dollars are being raised right now at breakneck speed for infrastructure that in most cases doesn't physically exist yet. The money is moving faster than the concrete. And this is the part where it stops being a story you can wave off as internet doom posting. On June 28, 2026, the Bank for International Settlements, the institution that effectively serves as the central bank for the world's central banks, published its annual economic report. It named an AI capex bust and the collapse of circular financing arrangements as among the top risks to global financial stability, right alongside record sovereign debt. Their language was carefully hedged, the way institutions like this always are, but the substance wasn't soft. Disappointment in returns could trigger a sudden pullback in financing and turn the capex boom into a protracted investment bust, with potential knock-on effects on financial conditions. The IMF has separately raised its own alarm about the debt mountain funding all of this. So by this point, you've seen the circular deals yourself, watched the debt pile up faster than the buildings, and now the actual central bank of central banks is using words like bust in an official report. That's not one skeptic's opinion stacking on another. That's three completely independent angles landing on the same conclusion. Now this next problem gets genuinely strange, and it isn't hidden in some complicated derivative. It's sitting in an accounting line item most people have never once thought about: depreciation. When a hyperscaler buys a stack of NVIDIA GPUs, it doesn't expense the full cost immediately. It spreads that cost out over the chip's assumed useful life, typically 5 to 6 years, reducing reported expenses and boosting reported profit in each of those years. The problem is, NVIDIA now ships a new chip generation roughly every year. Hopper, then Blackwell, then Rubin Ultra. And the real-world competitive lifespan of each generation is looking a lot closer to 2 or 3 years. Between 2023 and 2026 alone, something like $1.5 to $2 trillion in cumulative GPU-related spending has landed on corporate balance sheets under those same 5 to 6 year assumptions. Michael Burry, yes, the big short guy, has been the loudest voice putting a number on this. His estimate? If hyperscalers were forced to depreciate their GPUs on a schedule that actually matched reality, it could mean roughly $176 billion in understated depreciation and overstated profits across the industry between 2026 and 2028. He's compared the setup not to Enron, but to Cisco at the peak of the dot-com bubble, a genuinely great company that still got caught in wildly optimistic capital spending assumptions. And this next detail is what makes the problem almost impossible to argue with. NVIDIA's own CEO accidentally confirmed it himself. Jensen Huang, joking at an NVIDIA conference about how fast Blackwell was replacing the previous generation, said, "I said before that when Blackwell starts shipping in volume, you couldn't give Hoppers away." That's the company's own CEO on stage saying the old chips become nearly worthless practically overnight, the exact opposite of a 5 to 6 year useful life. This isn't hypothetical anymore either. Amazon's CFO already quietly shortened the useful life assumption on some of its servers and networking equipment, and it cut the company's operating income by about $700 million as a result. Barclays estimates that if Meta and Google made similar adjustments, it could knock $5 billion and $3.5 billion off their operating income, respectively. One company already took the hit. The rest are still using the friendlier math. So if everyone running these companies is this confident the spending is justified, you'd expect them to be holding on to their own stock, right? CoreWeave, one of the biggest neo-cloud providers renting out NVIDIA-powered computing to other AI companies, posted a net loss of $740 million and paid $536 million in interest expense. It burned through $4.7 billion in negative free cash flow and is carrying $50.8 billion in total liabilities. Its CEO, Michael Intrater, has sold roughly $55 million of his own stock in recent months, including a single $24 million sale in late July, while the company faces a pending securities fraud lawsuit specifically over delays in its data center construction. Meanwhile, NVIDIA insiders sold more than $500 million in shares in a single month this year. To be fair, a lot of that selling happens through pre-scheduled trading plans set up in advance, not a sudden panic. That's a real, meaningful distinction. But scheduled or not, it's still true. The people with the most detailed, non-public view into how these companies are actually performing are, in aggregate, choosing to hold less of their own stock, not more, at the exact moment the public story is, everything is fine. And this is where the risk stops being contained to tech investors, because it doesn't stay inside the companies building this stuff. According to reporting from the Boston Globe, a meaningful amount of risky data center debt is being repackaged into securities and sold off to insurance companies and other institutional investors. The same basic structure that turned a housing problem into a global financial crisis in 2008. I want to be careful here because overclaiming this would be dishonest. Nobody serious is saying this is a repeat of 2008, chip for chip. The scale is different, the asset is different, and today's tech giants are, at least for now, generating real revenue that dot-com era companies mostly weren't. But the structural shape should make you uneasy regardless. Complex debt, distributed widely, ending up on the books of institutions that are supposed to be the boring, safe part of the financial system. That's precisely the mechanism that turns a sector-specific problem into everyone's problem. Now, I'd be doing you a disservice if I let all of that stand unchallenged, because there is a real, serious bull case here, and it deserves genuine weight. Chip demand is not manufactured. NVIDIA's chips remain genuinely sold out in many categories, and that's not something you can fake with circular deals. Someone still has to actually run workloads on that hardware. Wall Street's most bullish analysts, including firms like Loop Capital and Barclays, still have price targets implying NVIDIA could be worth $5 to $6 trillion. The underlying models keep improving, adoption keeps growing, and unlike a lot of dot-com era companies, the businesses at the center of this boom mostly have enormous, genuinely growing revenue. It's entirely possible that everything in this video describes a sector working through the normal growing pains of an enormous, genuinely transformative build-out, not a collapse. But notice what even that bull case doesn't really dispute. The depreciation numbers are real. The debt is real. The circular deals are real. The disagreement isn't about whether these things exist. It's about whether they're a manageable growing pain or the load-bearing wall this entire boom is quietly resting on. So go back to what I asked you to watch for at the start of this video. How many times did the money in this story just move in a circle instead of flowing somewhere new? NVIDIA invests in OpenAI, which spends that money on NVIDIA chips. NVIDIA considers backstopping OpenAI's debt on a building that will house more NVIDIA chips. Hyperscalers borrow record amounts to build data centers whose useful life assumptions may not survive contact with NVIDIA's own release schedule. That's not the pattern of a boom expanding outward into new territory. That's the pattern of a boom that's already, quietly, looking for the exit, while telling everyone else it's just getting started. Nobody can tell you the exact date this either unwinds or doesn't. Anyone who claims they can time this precisely is selling you something. But you don't need a date to understand the shape of the risk sitting underneath a huge share of the market you're already invested in, whether you meant to be or not. Check what's actually inside your index funds. Understand how concentrated your own exposure already is. And the next time you hear a headline about a new multi-billion-dollar AI deal, ask the one question this entire video comes down to. Is this new money, or is it just the same money coming back around again? If you want to see how we traced a completely different hidden risk sitting inside people's portfolios, go watch the video right there on your screen next. Don't forget to like and subscribe for more.